Goldman Sachs just posted an absolutely massive 78% jump in profit. Meanwhile, inflation just came in far cooler than anyone expected. And yet somehow, the Federal Reserve rate hike odds barely budged.
Hello everyone, welcome back to AI Market News. Today, we're unpacking the market action for July 15th, 2026. It's the kickoff to earnings season, and a crucial inflation report has completely reshaped our market outlook in real time. We're seeing a really fascinating clash between exceptionally strong corporate earnings and shifting macroeconomic data. So let's walk through exactly what this means for all of us tracking these markets. Let's start with the headline numbers that really set the tone for the day. The June Consumer Price Index came in at 3.5% year over year. That's well below the 3.8% forecast. But what's even more striking is the monthly figure. Month over month, prices actually fell 0.4% versus an expected 0.1% decline. Based on available data, this represents the absolute largest monthly drop we've seen since April 2020.
Let's dive into the underlying mechanism at play here. The Federal Reserve operates on what's called a dual mandate. Their goal is to achieve both maximum employment and stable prices. When we see softer than expected inflation data, like this negative month-over-month print, it directly reduces the pressure on the Fed to keep raising interest rates to cool down the economy. Because of this dynamic, the odds of a July rate hike, which had actually climbed toward 50% earlier in the week on oil-driven inflation fears, just collapsed to under 20% within hours of the release. Now, we might expect a massive drop in yields based on that cool inflation data, but as we can see in the chart, the US 10-year Treasury yield didn't plummet. It dropped initially, sure, but ended up finishing the day only modestly lower at 4.579%. The reason for this firm floor in yields comes down to Fed Chair Warsh. At almost the exact same time as the CPI release, he delivered his first ever congressional testimony before the House Financial Services Committee. Rather than leaning dovish, he doubled down on hawkish language. He flat out refused to declare victory over inflation, stating the Fed does not consider its price stability mandate accomplished. This push and pull between cool data and a cautious Fed chair kept yields firmly anchored. Moving over to equities, we saw some really heavy lifting done by the big banks, which powered right through that hawkish overlay. Goldman Sachs kicked things off with a standout quarter, posting a massive 78% year-over-year jump in net income to $6.63 billion. JPMorgan Chase delivered impressively too, with net income up 41% to $21.1 billion. On the flip side, though, we saw IBM take a very heavy hit. Their stock tumbled more than 20% after issuing preliminary guidance that missed on both revenue growth and adjusted earnings per share.
The crucial point here is understanding the mechanism behind this stark divergence. Big bank trading revenue acts as a real-time indicator of capital markets activity. When banks like Goldman and JPMorgan show outsized trading gains, like the 72% surge in equity trading revenue we just saw for Goldman, it signals genuinely strong institutional market flow. Essentially, large financial players are actively moving capital. This sends a vastly different, much more robust signal to all of us than a tech hardware company like IBM struggling with underlying structural demand concerns. Tracking that institutional flow, and as the graph shows, the Nasdaq, powered higher, leading the indexes with a 0.90% gain to 26,107.01. This was largely driven by renewed strength in semiconductor names, including a solid 4.1% gain for NVIDIA. Meanwhile, the Dow Jones managed only a token 0.02% gain, weighed down heavily by IBM's slide. In the background, the VIX volatility index dropped to 16.32, which tells us that easing Middle East tensions are continuing to bleed volatility right out of the market. For our Japanese investor audience, it's absolutely vital we look at the dollar/yen action amid these shifting yields. As we can see in the chart, the pair remained remarkably stable today, trading around the 162 level. The mechanism here is a delicate balancing act. Normally, cooling U.S. inflation would significantly weaken the dollar against the yen. However, because Chair Warsh's hawkish tone kept U.S. yields from falling sharply, the critical yield differential between the U.S. and Japan stayed largely steady. This stable gap in interest rates prevented any drastic cross-border forex action today. This U.S. tech strength triggered a massive rally overseas, and as the graph shows, sent the Nikkei 225, Nikkei Heikin Kabuka, surging 1,008 points or 1.49%. The cross-border mechanism at work here is sentiment spillover. Strong U.S. tech performance, combined with an earnings beat from ASML in Europe, directly lifts Japanese chip equipment names. Global investors confidently buy into the broader semiconductor supply chain, pushing the Japanese index significantly higher for all of us invested there.
Before we close out today's explainer, let's take a look at the upcoming economic calendar, as tomorrow brings more key indicators we all need to watch. Tomorrow morning Eastern Time, we have the release of the June U.S. Producer Price Index. At 9:45 a.m. ET, we'll get the Bank of Canada interest rate decision, and shortly after, we have another highly anticipated appearance from Chair Warsh, this time delivering his testimony before the Senate Banking Committee. If we see a soft PPI paired with another hawkish Warsh appearance, we could very well see a repeat of today's market pattern: anchored yields and strong stock performance. The ultimate question for all of us investors now is, will tomorrow's PPI data finally force the Fed to change its tune, or are we in for a prolonged staring contest between the data and the central bank? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.